Hello everyone, I hope you guys are doing well and studies are going in full swing. In today's video, we would be discussing about Ind AS 33 on EPS, a very important standard from your CA financial reporting, along with all the important questions that are there for this chapter. So this will be a very helpful video and it will help you cover everything that is there in EPS. So if you have done this a long time back and you want a quick refresher or you want some help on the questions, this should be really helpful. So let us get started. Now when we look at EPS, this is covered under your CA Inter as AS 20 and under your CA final as Ind AS 33. EPS is one of the most important numbers on your financial statements, and it is as important that it has to be shown on the face of the income statement, both the basic as well as diluted. Now, how do you calculate the EPS? First, going into the basic EPS calculation, when we look at basic EPS, you take the net profit, which is attributable to the equity shareholders in the numerator, divided by the weighted average number of equity shares. Remember, basic EPS is basically based on actual data, and hence you will look at the pool of money which is available to the equity shareholders, not just items of equity. Remember, equity shareholders, there might be items like irredeemable preference shares with discretionary dividend. They might be in the nature of equity as per Ind AS 109. However, they are not equity shares. So basic EPS is for ordinary shares, that is equity shares, and hence it will deduct every expense for which is paid to other than equity shareholders in the numerator. So the numerator will be the profit after everything. So over here, when you calculate the numerator, this will be after all expenses, salaries, wages, everything, after taxes, both current and deferred, and even after any payments to preference shareholders, which may be a part of retained earnings. Basically, the pool of money which is available for equity shareholders will be taken in the numerator. A few special adjustments for preference shares will come. We will see that in some time. In the denominator, you take the weighted average number of equity shares, that is WANES. Usually, we just take for EPS the number of shares in the denominator, but the numerator is a for the year item, the denominator is as on date item, and hence they are not comparable. And hence we try to take the weighted average number of equity shares in the denominator, where the time for which the shares were outstanding would be taken as weights. Now, the WANES can be calculated in one of the two ways. Like if you see this example which is given below, over here, let's say on 1st of April 2017, you had 2 lakh shares. This may be outstanding for the entire 12 months. Then a fresh issue of shares at fair value on 30th June, this will be outstanding for 9 months. And conversion of preference shares into equity shares, this is on 1st of December, this will be outstanding for 4 months, that is December to March. Buyback will reduce your number of shares, that is on 1st of March, and hence this will be a negative number but into 1 by 12. And hence that will help you in calculating the weighted average number of equity shares on a lot by lot basis. Remember, another way to calculate this will be on a cumulative basis, where you can come to 241,667 in a very similar way. That is, you would say over here, for example, 2 lakh will be there intact for how many months? 3 months. After which new shares are issued, and hence you will have 2,50,000 for how many months? From 30th June to 1st of December, so maybe around 5 months. Then you will have another 20,000 shares which are issued, so 2,50,000 becomes 2,70,000. So over here, this is 2,70,000 into, for example, December, January, February, 3 months, and lastly, a buyback of 30,000, and hence you will have 2,40,000 into, let us say, 1 by 12. If you do the math, you will get exactly 241,667. This is a method which is very helpful if you were to do the calculation for right shares. And hence, there are two methods. One is what I call as a lot by lot. Every lot you give the time weight. And second is a cumulative method, where you take the cumulative shares outstanding for a particular period. Your answers under either methods will remain the same. Are we clear with this? So when I look at WANES, we say that the number of shares, the period for which these shares are outstanding, will be taken as weights. Second, what if there are partly paid up shares? Well, if there are partly paid up shares, you will convert them into equivalent fully paid up shares, and you will then take that into your EPS calculation. So that if there is a share, if there are 1,000 shares of rupees 5 each and the face value is 10, you will say 1,000 shares of rupees 5 will give me a capital of 1,000 into 5, that is equal to 5,000 divided by rupees 10, and hence that will be equivalent to capital provided by 500 fully paid shares, and in all your working we will take 500 fully paid shares for your calculation. Third is shares issued without consideration. Now these are also called as bonus shares or sometimes share split or share consolidation. Now usually when you issue shares, you get money, and this money can be deployed in the company, and hence your profits will increase. However, when you issue bonus shares, that is capitalization of reserves accountable to capital, or when you do a share split or a share consolidation, that is share capital accountable to share capital. These are basically book entries only, and hence they will not impact your total resources with the company. So the date when these issues happen, whether it is bonus, share split, etc., is irrelevant. So when will you adjust these bonus shares or share split? You will take them retrospectively from the earliest reported date or the date when the original shares were issued, whichever is later. Like for example, over here, if there was a bonus issue which was done somewhere during the year, let's say there were 1,000 shares which were in existence for the entire last year, and during the current year a 1:1 bonus is given. So 1,000 and another 1,000 becomes 2,000 shares. Now these additional 1,000 shares have been issued in the current year only. However, that does not provide me with more resources in the current year, and hence if I want to make my EPS comparable of the last year as well as the current year, I will assume that these bonus shares were also in existence at the earliest reported date. So if in the current year, my current year is the year 24-25, and the previous year that I have to show is the year 23-24. So over here I will assume that the bonus shares were in existence from the earliest reported date, that is 1st of April 2023, and hence it will be included in the entire last year as well. The only exception to this rule is if the original shares on which the bonus shares have been issued were issued somewhere in the middle of the year. Like for example, if let's say there are 1,000 shares in the current year, however in the last year there were 400 shares, and then 600 shares were issued in the middle of the last year. Now we can say that the bonus shares will be retrospectively adjusted, but in the current year we have given bonus shares on the entire 1,000 shares, but in the last year 400 shares were outstanding for the entire 12 months, but the 600 shares were outstanding only for 6 months. Now you cannot have a bonus share on these 600 shares outstanding for the entire 12 months when the original shares were only outstanding for 6 months, and hence you will adjust the bonus shares from the date when the original shares have been issued or the date which is the earliest reported date, whichever is later. It's a little difficult to understand, and hence we will do this along with the problem for a better understanding. Again, the way Institute adjusts bonus shares is by calculating what is called as a bonus adjustment factor. How do you calculate a bonus adjustment factor? Well, in the numerator, you will take the post-bonus number of shares divided by in the denominator pre-bonus number of shares. So if your bonus ratio was 1:1, that means post-bonus, I'll have 1 + 1, 2 shares. Pre-bonus, there was 1 share, and as a result, your bonus adjustment factor was 2:1, which means for every shares which were issued and in existence prior to the date of bonus, I will multiply directly the bonus adjustment factor. Remember, after the date of bonus, there will be no bonus shares, and hence we don't need to multiply. Basically, what we are trying to say is 400 shares pre-bonus are equivalent to 400 2/1, that is 800 shares post-bonus. 600 shares pre-bonus are equivalent to 600 2/1, that is equal to I think 1200 shares post-bonus, and that will be taking care of the bonus adjustment. Another important adjustment over here is for a term called as treasury shares. Remember, treasury shares are nothing but shares which have been bought back but not yet cancelled. In India, treasury shares are not as popular. In fact, most of them are not even allowed as per the Companies Act, subjected to certain exceptions. But internationally, countries like US, etc., treasury shares are very popular. From a student standpoint, one needs to remember that for all practical purposes, if you have bought back shares, that is treasury shares, it is treated similar to buyback. So for example, you had 1,000 shares and you had bought back 300 shares. That means net you have 700 shares remaining. In a similar way, if you had 1,000 shares and 300 shares are kept in the treasury, it will be treated as there are only 700 shares which are outstanding, and your WANES calculation will be based on 700 shares only. So the shares in the treasury are shares which have been bought back. They've not yet been cancelled, but at the end of the day, they're not held by outsiders, and hence they are treated as if these shares have been bought back, and hence 1,000 minus 300 on the basis of 700, you will do the calculation. So shares bought back, kept in the company and issued whenever needed, these are treasury shares to be deducted, and all working should be on the net basis after deducting the treasury shares. Now, before we proceed on to the rights issue, we would want to do two problems. Okay, so over here we will go to question number 3. We are discussing all the important questions. Well, there may be around 20-30 questions. However, we'll discuss around, I think, 12 to 14 important questions from your exam perspective, which will give you a complete coverage of everything which is relevant for this standard. So question number 3. On 1st January, there were 10 lakh shares in issue. On 20th February, the company issued 2 lakh shares at a fair value. And on 31st August, there was a bonus issue of 1 share for every 3 shares held. This is on 31st of August, 1 for 3. Remember, these will be given on all the shares which were issued as well as outstanding prior to the date of bonus. And on 30th November, we issued 2,50,000 shares at fair value. Do you think they will be entitled to any bonus shares? No, because they are after the date of bonus. Calculate the number of shares which would be used in the basic EPS calculation. Consider the reporting date as 31st December year end. Now, in such a case, what you will try to do is, you will try to calculate what is called as a bonus adjustment factor. Bonus adjustment factor will take the number of shares pre-bonus. I would say that for every 3 shares which are pre-bonus, there will be 1 bonus share which is issued. And hence, I will say that 3 shares pre-bonus are equivalent to 4 shares post-bonus. And hence, 4 by 3 is your bonus adjustment factor. Now, what will I do? When I have to calculate WANES, I will say there were 10 lakh shares at the start of the year. These 10 lakh shares were pre-bonus. However, on that bonus shares will be issued. So into 4 by 3, I will multiply a bonus adjustment factor into 12 by 12. Okay. Plus, there were another 2 lakh shares that were issued. However, they were issued on 28th of February and hence they will be outstanding for 10 months. And hence, I will say into 10 by 12. But will they also be entitled to bonus shares? Yes. And as a result, I will do into 4 by 3 over here into 10 by 12. Now, what do you guys think? After this, will I again need to add the bonus shares? The answer is no. Why? Because bonus shares would be on these 10 lakhs, which I've already adjusted. On these 2 lakhs, when I do 4 by 3, I've already adjusted. So 10 plus 2, that is equal to 12 lakhs. Whatever are the bonus shares have already been adjusted, and whatever is the time value adjustment has been done. I'll have to retrospectively adjust. So I don't have to add the bonus shares separately. However, on 30th of November, have I further issued 2,50,000 shares? Yes. Will they be entitled to any bonus? No. And hence I don't need to do a 4 by 3 adjustment over here. Into this is outstanding by 1 by 12. And if I multiply this, I will probably be getting around 15,76,388. You can just verify that once. Remember, the mistake that you will end up doing is, when you see this, you will say, okay, on 31st August, if the bonus are there, till date there were 12 lakh shares, you might end up doing 12 lakhs into 1 by 3, that is equal to 4 lakhs bonus shares. And you will say, I will adjust 4 lakhs retrospectively from the 1st January date, which is wrong, because this 12 lakhs is made up of this 10 lakhs, on which whatever bonus shares are there can be adjusted from 1st of January, as well as 2 lakhs, which was itself in existence on 20th of February. And hence bonus shares on that cannot be in existence prior to that. So over here, one needs to remember that bonus shares cannot be in existence prior to the original shares. Like a child cannot come before the father. Right? Let that sink in. So in a similar way, bonus shares cannot come before the original shares are in existence. And hence this is the way you calculate WANES in case of bonus shares. Okay, so this is question number 3. Now we will flip back to a recent RTP question. This is question number 22. You can just focus on your screen. You would have probably done this, but this is RTP of May 23. So let us focus this. This is based on the Treasury Shares concept. Whether you have done it or not, you can just focus on this and this will give you a lot more clarity. Company P has both ordinary shares and equity classified preference shares in issue. We have been clearly given that these are equity classified, which means these are preference shares which are in the nature of equity. Remember, when we discussed about the numerator, in the numerator, what did we say? We said numerator has to have net profit, not just net profit in the income statement. This is net profit as per available for ordinary shareholders. Now the problem over here is, when you look at preference dividend, in your CA inter you were taught that net profit minus preference dividend should be taken in the numerator. However, at CA final, once you do Ind AS 109, there may be certain preference shares which are in the nature of liability. If there's any payment which is made to these preference shares which are in the nature of liability, can I say this preference dividend will go as a part of finance cost? Yes. If it is a part of finance cost, what do you guys think? Will that already be deducted while calculating net profit? Yes. Do I need to deduct the preference dividend again? No. See, preference dividend has to be deducted, but it is already deducted as a part of finance cost and hence I don't need to deduct it again. Whereas, if these preference shares are classified in the nature of equity, like an irredeemable preference shares with discretionary dividend, in which case, these preference shares are in nature of equity, and hence if I make a payment to these preference shareholders, a discretionary payment, this will be a payment to equity items and hence it will be adjusted against retained earnings and not a part of finance cost. However, this is still a payment made to preference shareholders, not to ordinary shareholders, and hence this will impact the pool of money which is available to ordinary shareholders, and hence this needs to be deducted. However, it has not yet been deducted for finance cost, and hence I'll have to deduct it separately. So over here, if I look at the numerator of basic EPS calculation, before I refer question 22, the profit for equity shareholders should be calculated after deducting all expenses, including taxes and preference dividend and other payments to the preference shareholders, which can be like premium or discount on redemption or conversion of preference shares. Now, this is irrespective of whether the preference shares are classified as equity or liability. I need to deduct it. The thing is, if there's already been deducted, I don't need to deduct it again. But otherwise, I need to actually deduct it. Okay, so when I look at preference dividend, preference shares which are in the nature of financial liability, preference dividend is already included in finance cost, and hence it would have already been deducted while calculating profit, and hence no separate adjustment is needed. However, if preference shares are classified as equity, then the preference dividend would be an appropriation and hence would be adjusted against retained earnings, and hence while calculating the profit, I need to deduct it separately in order to calculate the profit for equity shareholders. The long story short is they have to be deducted. If they were classified as liability, they would have already been deducted, and hence I don't need to deduct it again. But if they are classified as equity, then I don't really need to deduct it from finance cost, but I need to deduct it while calculating net profit for equity shareholders, and hence I'll have to separately adjust it. Now, earlier the institute solutions were slightly inconsistent when it came to premium or discount on redemption of preference shares. Since then, over the last 1 or 2 years, Institute has rectified it, and it had made a consistent and correct treatment whereby even if there is a preference dividend or a premium or a discount on redemption of preference shares, if it is classified as liability, then you will take it along with finance cost. If it is classified as equity, then you will take it in retained earnings, and then while calculating basic EPS, subtract it separately. Okay, so over here for premium or discount on early settlement, as per the update treatment by ICAI, the premium or discount is assumed to be adjusted in the P&L or retained earnings based on whether it is classified as a liability or equity, which is very similar to the preference dividend treatment. Again, within preference shares, there can be a cumulative preference share or a non-cumulative preference share. If it is a cumulative preference share, then the preference dividend would be deducted irrespective of whether it is paid or declared or not, because that is accruing. But a non-cumulative, it becomes a liability only when it is declared / paid, and hence a non-cumulative preference dividend will only be deducted when it is paid or declared, whereas a cumulative preference shares will be deducted in each year on accrual basis irrespective of when it is paid or when it is declared. Okay, so we will keep that into consideration and then probably go to question number 22. Now, P has both ordinary shares and equity classified as preference shares. Okay, the reconciliation of the number of shares during year 1 is set out below. On 1st of April, the balance is 30 lakh shares. Treasury shares are 5 lakhs and there are 5 lakh preference shares. So, if I look at the net amount, net of the treasury shares, can I say there would be 25 lakh equity shares? 30 lakhs are there, 5 lakhs have been bought back, and hence there are net 25 lakh shares. Next, you have bonus issue of 5%. No corresponding changes in resources. So, bonus issue on these 30 lakhs of 5% comes to 1 lakh 25, and there are 5 lakhs over another 25,000 of bonus shares which are on shares which have been bought back. So, basically net you can say 25 lakhs into 5% comes to 125, or 1 lakh 50 minus 25. Can I say this is 125? Now, this may be issued on 15th of April. However, can I say they would be outstanding from the start of the year? And hence, we will take this 1 lakh 25 from the start of the year. If there's a repurchase of shares for cash, this is a further buyback on the treasury shares, and hence you will subtract 2 lakh shares. And then there are fresh shares issued for cash of 4 lakhs. So, there is a lot of action happening over here. Now, the following additional information is relevant for year 1. Company P's net profit for the year is 46 lakhs. This is net profit. Think and tell me. Pause, think. Do you think this 46 lakhs is after preference dividend or before preference dividend? Sir, preference shares are classified as equity, and hence this 46 lakhs would be before deducting preference dividend, because preference shares are equity. Their payment would be adjusted directly from retained earnings because it is a payment to the owners and will not be a part of finance cost. So, for EPS calculation, will I have to subtract it separately? Yes. Now, on 15th February, the non-cumulative preference dividend of 1.2 was declared. Now, if it is non-cumulative, it will be deducted when it is declared and paid. Over here, this has been declared and hence we will consider. 1.2. The dividends were paid on 15th of March. Preference shares do not participate in additional dividends with ordinary shares. That's fine. Now, dividends on non-cumulative preference shares are deductible for tax purposes. Remember, unless given otherwise, we assume they are not deductible. But if the question tells you they are deductible, then these dividends will also impact tax. The applicable income tax rate is 30%. Ind AS 12 will teach you that if there is a tax impact over here, that will be taken along with the preference dividend. The financial year ends on 31st March. Determine the basic EPS of the company for the year 1. Use the number of months or part of the months rather than the number of days. Okay, so when I look at the profits in the numerator, I will say 46 lakhs is my profit, but this must be before a preference dividend, and hence I will say there are 5 lakh preference shares into 1.2. So I can say approximately 6 lakhs is my preference dividend. However, this preference dividend is tax deductible. So when I pay the 6 lakhs, I will also get a tax deduction, and hence my net cost will be 6 lakhs into 1 minus 0.3, because yes, 6 lakhs is my cost, which is not considered in 46 lakhs. However, this 6 lakhs will also come with the tax saving, and hence after considering all of that, 6 lakhs into 1 minus t. Now, when I look at my denominator, there are various ways in which you can solve. You can either take the bonus adjustment factor, which will probably be 1.05 is to 1, multiply it to this 25 lakhs and solve, or you can do this using a lot by lot method. Either way, so if I look at bonus adjustment factor, I will say there were 25 lakh shares which were in existence 1.05, that is 1 share pre-bonus plus 5% becomes 1.05 shares post-bonus into 12 by 12. Alternatively, I can say 25 lakhs into 12 by 12 ka weight and another 1,25,000 also into 12 by 12 ka weight. It is exactly the same. After that, there is a buyback. Buyback reduces the number of shares. So this is 2 lakhs. When is this buyback happening? On 1st May, and hence into 11 by 12 ka adjustment. And then plus you will have another 4 lakh shares. Are these shares entitled to any bonus shares? No, these are after. And hence this will directly be there on 1st of November, so into 5 by 12. So if I look at this in the numerator, probably all said and done, I will get 41 lakh 80. Okay, this is 6 lakh into 1 minus 8, that is 4 lakh 20, and hence 41 lakh 80 in the denominator. If I do this, 25 lakhs into 1.05, this is 2625, and 2 lakhs into 11 by 12, you will subtract it. 1,83,333 subtract, and 4 lakhs into 5 by 12. Add, and hence this is 26 lakh 8,333. A lot of students think that we will also add the preference shares in the denominator. Why? Because they are equity classified. Remember, EPS is earning per ordinary share, and hence these preference shares, even if they are classified as equity, they are not equity shares, and hence they will not be added into the denominator. And hence over here you will have 41 lakh 80 divided by 26 lakh and something, and hence you will get 1.602 or 603 as a case. Maybe this is your basic EPS. Is everyone clear with this? Yes? Okay, so this takes care of an important question 22 as well. Now, before you proceed further, there is also another question which involves the detailed understanding of preference dividend. So if we review that, so that you understand when should preference dividend be separately deducted and when can you assume that it would have already been deducted. So if you go to question number 6, this is for preference shares. Over here, the last line, if you see, the profit for the year is 1,50,000. Determine the adjustments for the purpose of calculating EPS. Over here, you just have to calculate the numerator properly. So I will start with my given net profit of 1,50,000. Remember, probably the person who has said this question does not have a very detailed understanding of Ind AS 109. So what you will do is you will do as the question tells you. If the question tells you it is liability classified, well, it is liability classified. If it is equity classified, well, it is equity classified. Okay, so let us review this. An entity has the following preference shares in issue at the end of 2014. First, a 5% redeemable non-cumulative preference share. These shares are classified as liability. Okay, if they are classified as liability, then the preference dividend would have gone in the finance cost. Do I need to deduct it again separately? The answer is no. During the year, a dividend was paid of 5% on these shares. Well, there are 1 lakh into 5%. Maybe during the year, 5% preference dividend was paid. But the fact that this is classified as liability, can I say that preference dividend would have already been deducted while calculating finance cost and the net profit? And hence, do I need to deduct it again? No. And hence, there is no separate adjustment needed for the first case. Second, increasing rate, cumulative non-redeemable preference shares issued at a discount of in 2010. Okay, and a cumulative dividend comes at 10%. These shares are issued at a discount as compared to compensate the holders because the dividends will not commence till 2015. The accrual of discount in the current year calculated using effective interest method is say 18,000. Now, if there's an accrual of discount of 18,000 and these shares are classified as what? They're classified as equity, which means this 18,000 would have gone where? Well, it would have gone to retained earnings. Now, you might always argue that how did that 18,000 come? That is beyond the scope over here. If they've told you, well, we have to take it. That maybe there's a cost of 18,000 for an equity item and hence it would have gone to the retained earnings. Remember, when you pay interest on debentures, it is towards a liability, it will go as finance goes. But when you pay equity dividend, it goes to retained earnings. In a similar way, over here, this 18,000 will be deducted, let us say, from the retained earnings. However, this is attributable to preference shareholders, and will that impact the profit for equity shareholders? Yes. And hence, I will subtract this 18,000 separately. It should have been deducted, was not deducted in finance cost, and hence I subtracted separately for the purpose of EPS. Point number 2. Point number 3, 8% non-redeemable, non-cumulative preference shares. Now, at the beginning of the year, you had 1 lakh, 8% preference shares outstanding, but on 30th June, it repurchased 50,000 of the shares at a discount of 1,000, which means 50,000 ka cheez you bought back at 49,000, and hence there was a gain on early redemption of 1,000. Now they have, so the remaining items are 50,000. They have not specifically told you whether these preference shares are equity or liability, and hence you have to apply your understanding as per 109. Now, as per Ind AS 109, if it is non-redeemable, it is in the nature of liability or equity. Well, it is equity. Equity as a non-redeemable or perpetuity feature. Non-cumulative. Remember, liability you have to pay. If it is non-cumulative, that is not mandatory. That is a feature of equity, and hence this entire instrument is equity. If it is equity, then the gain, if any, on redemption, your entry will be, let's say, preference shares account debit 50,000, to bank 49,000, to gain on redemption 1,000. This is a gain to preference shareholders. However, this is a gain on early redemption of preference shareholders. However, would it have gone in your statement of P&L? No. Why? Because this is for an equity item, and hence will I have to adjust it separately? Yes. And hence this 1,000 is separately adjusted. Then you have 7% cumulative convertible preference shares converted during the year. These shares were classified as equity, clearly given to you. Over here, the institute has made certain changes in its solutions, and hence that is correct, and we will solve in line with the institute's correct updated solutions. Now, these shares are classified as equity, and their conversion into ordinary shares was at the beginning of the year. No dividend was accrued in respect of the year, although previous years dividend was paid immediately prior to conversion. To induce conversion, the terms of conversion of, so the thing is over here, no dividend was accrued in respect of the year, although previous year's dividend was immediately paid in the current year. But if they are cumulative preference shares, the dividend must have accrued in the last year, and you would have deducted in the last year. You would not have waited till payment release in the cumulative shares, and hence for the dividend I don't need to adjust it in the current year separately. It must have already been deducted in the last year. Now, to induce conversion, the terms of the conversion of these preference shares were amended, and the revised terms entitled the preference shares to an additional 100 ordinary shares at a fair value of 300. So can I say 100 additional shares at 300, and hence for 30,000 you are paying additionally. To whom are you paying? Well, you are paying to preference shares which are classified as equity. So whatever over this preference shares account debit, additional payment against the retained earnings account debit to, let us say, share capital, securities premium, whatever it is. Can I say 30,000 additional? Yes. Earlier institute was ignoring it. Now correctly it has considered, because these are payment to equity items, and it would not have gone in the P&L because it is a payment to equity item which goes under retained earnings, and hence I will subtract this separately. This is a 30,000 additional payment, and hence your adjusted balance would be what? 150 minus 18 plus 1 minus 30. So over here, can I say 1,03,000? Yes. Now this might not directly come in the same form. However, in a bigger question, whether I should separately subtract preference dividend or a premium or discount is something that you can clearly apply by taking the understanding over here. Okay, so this is regarding preference shares. There's also one more point regarding a participating preference share, which we will do in some time. And then you go to the next part, which is on rights share. So when you look at a rights issue has a share which is issued for lower than fair value to the existing shareholders. So if the shares are issued at fair value, then you take it into the WANES from the date they are issued. If the shares are issued completely free of cost, then you take it from the earliest reported date, because these are bonus shares. However, when you look at rights issue, it has a mixture of both, because the shares are issued at a discount, so there is a hidden bonus, and the shares are also bringing in some consideration, and hence there is a hidden share issue for consideration. So what do you do? Well, I will have to find the hidden bonus ratio, for which the standard specifies 3 clear steps. The standard says in step number 1, you calculate something called as the theoretical ex-rights price. This is nothing but the post-rights price. How do you calculate it? Well, you calculate it as a weighted average price. Like we say that what is the value of a share prior to the rights, after the rights, theoretically what should be the value of the share. We will try to understand this with an example so that you get a better understanding on each of these steps. So the 3 steps over here is, just to be clear, for a rights issue, you will have step number 1, calculate theoretical ex-rights price, which is a weighted average price. In the numerator, you will take the pre-right number of shares into the price per share pre the rights plus the number of shares that you are issuing under the rights into the rights issue price. Like the rights ratio is, let's say, 1:4, in which case there were 4 shares pre the rights into whatever is the price pre the rights plus 1 right share into whatever is the right issue price. So this will be the total value post the rights divided by 4 plus 1, that is equal to post rights price. So post right number of shares. So basically you are saying post right price is nothing but the post right value in the numerator divided by the post right number of shares in the denominator. Now next step is you calculate the rights adjustment factor. What is the rights adjustment factor? In the numerator, you take the pre-rights price. In the denominator, you take the theoretical ex-rights price. Sir, why should this give you the hidden bonus? It is like saying that, let's say your current market price before the bonus was 100 and the bonus ratio was 1:1. Can I say post bonus, you would know by now that the price will adjust down to 50 rupees. Now let us say you don't know the bonus ratio. You don't know the bonus ratio, you just know these prices. Can I say when I do the price pre the bonus, that is 100, divided by the price after the bonus, that is 50, I will get 2:1. What does this 2:1 mean? In the numerator, I am saying post bonus, if there are 2 shares, pre bonus there was 1 share. So is that an indirect way of finding your hidden bonus ratio? Here bonus ratio was given as 1:1, but in rights, I don't know how much of that is a hidden bonus ratio. We are saying that if the rights were made at fair value, the price would not have fallen. The fall in the price signifies the hidden bonus element, and as a result, over here, the fair value prior to the date of rights upon the theoretical ex-rights price. If you understand the logic, great. Otherwise, just remember the formula: fair value prior to the rights divided by the theoretical ex-rights price will give you the rights adjustment factor. It is like the bonus adjustment factor, which you will multiply by all the number of shares which are issued and outstanding prior to the date of rights. So multiply the RAF to the shares which are outstanding and issued prior to the date of exercise of rights. No adjustment for RAF needs to be done to the shares which are outstanding after the date of right. Remember, even for bonus shares, you used to multiply the bonus shares to the shares which were issued and outstanding prior to the date of bonus. After the date of bonus, if there were any shares, then you don't need to multiply, because on that you don't get these bonus shares. In a similar way, if the rights was on 1st March, then to all the shares which are issued and outstanding prior to 1st March, you will multiply the rights adjustment factor. For rights issue, I would strongly recommend that you do the WANES calculation on a cumulative basis, because it is a lot more easier. For WANES over here should be calculated on a cumulative basis, that is, for the first 2 months, whatever are the shares into the rights adjustment factor into 2/12. Then in the next 10 months, whatever are the number of shares, no multiplication of rights adjustment factor into 10/12. Best understood by doing a problem. So over here, an important problem, question number 5 for rights issue would be where you are supposed to calculate the EPS. calculate the EPS when the profit attributable to ordinary shareholders is given to you for three of the years. Shares outstanding before the rights issue are 500. Rights issue is 1 new share for each of the 5 shares outstanding. So the ratio is 1:5. Exercise price is 5. Date of the issue of right is 1st January and last date to exercise rights is 1st March. The market price of one ordinary share immediately before the exercise on 1st March is 11 rupees. The reporting date over here is 31st December. Remember, this is a calendar year concept. So over here what is happening is we need to first see when the rights is happening. So rights is happening in March of 11. So in 2010 there was no rights. During 2011 there was rights, and in 2012 this is after the point of rights. So over here the 3 steps would be: first, to calculate theoretical X rights price. Your X rights price will be the number of shares pre the rights, which are 5 shares. For example, you can even take 500 shares over here, into the value of the share pre the rights. Can I say this is 11 rupees? So there are 5 shares worth 11. But post right, along with the 5 shares worth 11, you will also get 1 share. But for that 1 share, you will only have to pay 5 rupees. So the value post the right, this can be for 500 shares in total, the pre-right market cap, and 100 into 5, that is the total proceeds that you will receive on right, divided by the post right number of shares, that is 5 plus 1 is equal to 6. So this is probably 60 divided by 6, and hence can I say post right, the price will fall down to 10 rupees. Next, you will calculate, for example, your rights adjustment factor. How do you calculate the rights adjustment factor? Well, the fall in the price of rights, 11 by 10 comes to, I think, 1.1. So there is a hidden bonus element of 0.1. Let us say 1 share pre-bonus becomes 1.1 shares post bonus, and hence 0.1 must be the hidden bonus element. And hence when I try to multiply, I will say that your restated EPS for 2010 will be 1100. Well, there were 500 shares. This is entirely prior to the date of rights, into 1.1 into 12 by 12, and hence this is 1100 by 550 comes to, let's say, 2. Second, for 2011 you will have 1500. In the denominator, however, you will say that at the beginning there were 500 shares into 1.1. Acha, this will be outstanding for how many months? Sir, 2 months on a cumulative basis. After that, can I say, along with the 500 shares, you have issued into 1 by 5, 100 right shares. These 100 right shares will include shares which were issued for consideration, as well as shares which were issued without consideration. So let us say simplistically, 50 shares were issued for consideration, 50 shares were issued without consideration. At the end of the day, this will be 600. Now, I don't need to separately adjust anything over here. 600 into, can I say, 10 by 12, and as a result this will be 1500 divided by, I can say, 550 into 2 by 12 m plus, and 600 into 10 by 12 m plus, and hence what do I get? Just a second. 550 into 2 by 12 m plus, and 600, which includes everything and no further adjustment is needed, into 10 by 12. This is a cumulative basis working, and hence this is what, 591.67 maybe, and hence if I do this working, 1500 by 591.67, you can even take this in decimals because this is an average number. This is 2.54 approximately. Now when I go to the last year, this is 2012, my profits are 1800. Now do I need to multiply the rights adjustment factor again? No. For this entire year, there were 600 shares. This is after the date of rights, and hence I don't need to multiply the RAF separately, into 12 by 12, and hence this is 1800 divided by 600, and hence can I say this is 3 rupees. Yes, this is what we say as your basic EPS after the adjustment for rights. Now you are almost done with the basic EPS working. There is a special case which is given in the appendix to Ind AS 33 pertaining to participating preference shares. Now what do you mean by participating preference shares? These are preference shares which participate in the profits along with your regular equity shares. Now usually when we calculate the profit available for equity shareholders, we say that we will take let us say the profit. From that, if required, you subtract the fixed preference dividend, and that is a pool of money which is available for equity shares. Whether it is distributed or not is secondary. However, if there are participating preference shares, in that pool of money, some part will also be taken by participating preference shares, and hence the appendix gives you 4 steps which you need to follow in order to arrive at the EPS for ordinary shareholders. Step number 1, you will try to find the undistributed profit. Undistributed profit is that pool of money which is available for distributing both to the equity shares as well as to the participating preference shares. So over here, you will first try to calculate undistributed profit. While doing so, you will deduct the fixed preference dividend if there is an agreement, and also a fixed equity dividend if there is an agreement, which has to be paid before you actually end up paying a preference dividend. So we will try to find that. That is a pool of money which is now to be shared between the equity shares and the preference shares. But there will be a ratio. You might be told that 20% per preference share against 100% for an equity share. And hence, you will have to say that let the dividend per equity share be X, then the dividend, additional dividend per preference share will be 0.2X. So over here, you will find the allocation per equity share, and then based on that, the allocation per share. You can take one of them as X and other based on the agreed relationship. We will do a problem based on that. Then you will formulate an equation. We will say that, okay, at the end of the day, if there are 10,000 preference shares, 10,000 preference shares into, for example, 0.2X will be the additional dividend flowing to the preference shareholders. And if there are 50,000 equity shares, 50,000 into X will be the additional dividend flowing to the equity shares if everything were to be distributed. And that total has to be equal to the undistributed profit. So over here, your total undistributed profit will be the number of equity shares into the allocation per equity share, let us say X, plus the number of preference shares into allocation per preference share. With this, only X is a missing variable, and we can find how much is the additional dividend flowing to the equity share and the preference share. So EPS needs to be separately calculated for equity shares as well as participating preference shares. EPS is what? Distributed dividend plus your share in the undistributed dividend. Till now, we did not really bother because we said that even if the dividend is not distributed, if it was distributed, everything would have flowed to the equity shareholder. Here, that is not the case. If it was distributed, some of this would have gone to the participating preference shareholder, and the remaining would have come to the equity shareholder, and hence your EPS will be calculated based on that. Over here, we will go to a question number 8, which will give us a fairly good understanding of the application of this concept. So over here, question 8, a lot of questions in the study material have this paragraph. That is, they said that this question does not illustrate the classification of components of convertible instruments into liability and equity, or the classification of the related interest and dividends as expenses and equity as required by 109. So what this means is, you don't really need to go into Ind AS 32 or 109 application. We will say that we will go to the legal form. If preference shares are owners, payment to them, that is preference dividend, is like a retained earning adjustment. It is like an appropriation. Over here, you have the net profit after tax, but before preference dividend. Remember, when this line is given, if it is given, then we need to remember that the profit over here will be based on the legal form. And preference shares, we don't have to go to the liability equity classification. We say preference shares are shares, so they might be owners, and hence preference dividend would have been deducted from retained earnings if it was deducted. This is 1 lakh clearly given to you before preference dividend. Ordinary shares outstanding are 10,000. Non-convertible preference shares are 6,000. Now the non-cumulative annual dividend on preference shares before any dividend can be paid on ordinary shares is 5.5. Can I say this is a fixed preference dividend to be paid before any equity dividend is to be paid? Yes, sir. After ordinary shares have been paid a dividend of 2.1. Achha, when will they be paid a dividend of 2.1? After preference shares ko you have given 5.5. Have been given a 2.1, the preference shares participate in any additional dividend on a 20:80 ratio with the ordinary shares. So if the ordinary shares get 80, preference shares will get 20. Compute the allocation of earnings for the purpose of calculation of basic EPS when an entity has ordinary shares and participating preference shares which are not convertible into the ordinary shares. Now what will I do? I will first try to find the undistributed profit, which is, I would say, 1 lakh rupees. Out of it, I would say first, if I had to, before they start sharing, I have to first pay the preference shares. That is 6,000 into 5.5. 6,000 into 5.5 probably comes to around 33,000. Now this is a pool of money which can be shared? No. after this I will have to pay equity dividend. So the equity dividend over here would be, for example, 10,000 into 2.1. Can I say this is equity dividend? This is 21,000, and hence what you are left over with is 33 and 21 minus 1 lakh. This is 46,000. Can I say this is undistributed profit? This is undistributed profit. However, if I had to distribute, can I say everything will flow to equity? No. If equity X flows, let's say that is equal to 80, then to preference shares 20 will flow. Acha, so how much will flow to the preference shares? Can I say to the preference shares 20 divided by 80 into X, that is 0.25X will flow. Remember, the ratio is not 20% of equity, it is 20:80, which means if 80 is going to the preference share, 80 is going to the equity share, 20 will go to the preference share, and hence if 80 is equal to X, then 20 is how much? You will cross multiply and you will get probably 0.25X. So this will be 0.25X. Now this is per shareholder. X is what per equity shareholder gets. 0.25X is what per preference shareholder gets. Which means if I were to formulate an equation, I'll say there are 6,000 preference shareholders, each of which will get 0.25X, and there are 10,000 equity shareholders, each of which will get X. And if everyone has to be paid, the amount that I have to pay them is only 46,000, and hence over here this is what 6,000 into 0.25 comes to 1,500. This is 11,500X equals 46,000, and therefore you can say 46 divided by 11,500. Can I say X equals 4 and 0.25X equals 1. So when I look at the earning per equity share, I will say equity share will definitely get this 2.1. But over and above that, out of the undistributed profits, if they are distributed, equity share will get another 4. So 2.1 plus 4, can I say 6.1 will be my EPS for equity shares. Further, the participating preference share will get a fixed 5.5. However, additionally, out of the additional pool, he will get 1, and hence this is 6.5. So your EPS, what people would have done is they would have said, Acha, this is 1 lakh minus 33,000 paid to the preference shares, which means you're left with 67,000. 67,000 को directly divide करो 10,000 से 6.7 will be your EPS, which is wrong, which would have been the case if these preference shares were not participating. If I decide to distribute the entire 67,000, first 21 will go to the equity shares, remaining 46 will remain, out of which some amount will go to the preference shares and only the remaining will go to the equity shares, and this is how you will calculate that amount which is flowing to the equity shares. Are we clear with this? Okay, so this by and large takes care of your working for basic EPS. Before you go into the diluted EPS, a couple of special things that you have to remember in case of OCI as well as NCI. Remember, it is possible that there is another comprehensive income. Let's say your PAT, for example, is 100. Then in OCI, there can be a non-reclassifiable OCI like a revaluation reserve of 50. And there can be a reclassifiable OCI like a foreign currency transaction reserve of 20. And hence your OCI would be 70. And your total comprehensive income would be 170, which is 100 plus 70. Can I say this would be 170? Now, what do you guys think? Is your EPS based on total comprehensive income divided by number of shares, or is it based on profit divided by number of shares? Sir, profit, and hence this is before OCI, and hence you will take 100 as a base. Other comprehensive income items, though going in total comprehensive income, they will not impact your EPS calculation. Are we absolutely clear with this? Okay, so over here, as you can see, for EPS, we take the net profit and not total comprehensive income. That is before considering OCI. Now, what might happen is there might be another adjustment, like, for example, there is a company Reliance, RIL, the petroleum company, has earned 1,000 during the year. Other than that, it has a subsidiary Jio, which has earned probably 100 rupees during the year. Now, Jio ke andar Reliance has close to a 70% stake and 30% is held by outsiders, which means when I do consolidation, when you do consolidation, you remember you will do a line by line consolidation of 100% of the income, 100% of the expenses. So what will happen is you will find total 1100 to be your consolidated PNL. And below this, you will say out of this 1100, I can say, can I say 30%, that is 30 rupees, is attributable to the minorities. 70% of 100, that is 70, will be attributable to the parent. 1000 entirely is attributable to parent only. So I will say out of this 1100, maybe 1070 is attributable to the shareholders of the parent, and to the non-controlling interest, let us say 30 is attributable. Now the question is, all of this is net profit. Let us say there is no other comprehensive income. All of this is net profit. How much of this will be taken to be your EPS? Well, when I calculate EPS, remember EPS will be divided by number of shares. When you do consolidation in the denominator, when you prepare the consolidated balance sheet, share capital is whose share capital? Is it only parent share capital? Yes. Do I add subsidiaries number of shares in the denominator? No. Do I add the NCI in the denominator? No. When I look at my consolidated balance sheet, the number of shares that I will see in my consolidated balance sheet will only be the parent's number of shares, and as a result, in my denominator, I will only have the parent's number of shares. I don't add the shares held by NCI separately in my share capital schedule, and hence, if I take my EPS is the profit available in the numerator divided by the number of shares in the denominator. The number of shares in the denominator are parent's number of shares, and hence, what do you guys think? Think and tell me. Will I take 1100, which is belonging to parent and also to minorities, or only 1070? Well, only 1070, and hence you will take the profit which is attributable to the parent only, that is 1070. NCI share of profit will not be considered. In the denominator, we take the number of shares existing in the parent company. Shares held by NCI are not included in the denominator. Hence, the net profit should be including profit attributable only to the shareholders of the parent without considering the profit attributable to NCI, and hence 1070. In fact, if 1100 is given, from that you remove 30 and come to 1070. These are two very important things that you have to remember if a bigger question appears. And that takes care of the first part of the standard with the sums of basic EPS. So we'll continue further into the more important section from this chapter, which is on diluted EPS. Now, what does diluted EPS mean? It means that if a company has certain potential equity shares which have the potential to become equity shares, which can be like a convertible debenture, it can be a convertible preference share, it can be options or warrants, or it can also be contingent shares, but they do have the potential to become equity shares. Remember, how they are currently classified does not really matter. They may be currently classified as an equity item or a liability item, that does not really matter. They have to have the potential to become equity shares for them to be diluted EPS. To be taken for the purpose of diluted EPS. So when we look at diluted EPS, Ind AS 33 says that let us assume that these potential equity shares, which were actually potential, convert into actual equity shares. Have they actually converted? Well, probably not. But what if they do? If they do, then what will be the impact of EPS? Now, few crucial questions need to be answered before you go ahead over here. First is, if they do convert, from when will they convert? Well, the standard assumes that they will convert from the start of the year or the date of issue, whichever is later. Like if a convertible debenture has been issued 10 years back, I'm not preparing financials for 10 years, but if I'm preparing for the current year, then I'll assume that it was converted into equity shares at the start of the year. Or let us say the convertible debentures were issued somewhere during the year, 6 months down on 30th September 2024, in which case we will assume that, well, if they had to convert, the earliest date they will convert is 30th September 2005. So they have not actually converted, so we assume that they will be potential from the date they were actually issued or the date of or the start of the year, whichever is later. And till when do they remain potential? Well, till the end of the year or till the date they have been converted or redeemed, whichever is earlier. So it is very much possible that these instruments were outstanding since the last 10 years. However, during the current year on 31st December 2024, these got converted into equity shares. So these got redeemed. However, EPS is for the year, and hence for the first 9 months they were potential, and hence they will be going into the diluted EPS calculation. So when we look at diluted EPS, remember, this is the EPS, or rather the worst possible or the lowest. Stake dilution means stake reduction. The lowest possible EPS that you can possibly earn if the potential equity shares, which had the potential, became actual equity shares. So this is probably the worst or the lowest possible EPS, considering potential equity shares, which we just discussed, are actually converted. And potential shares are those instruments which have the potential to become equity shares. Remember, irredeemable preference shares with discretionary interest, they may be classified as equity, but they don't have the potential to become equity share, and hence they are not taken into the diluted EPS calculation. Okay, the conversion or exercise is assumed to happen at the beginning of the year or the earliest reported date, whichever is over here later. And till what time? Ajay, an important point over here is, when you calculate the diluted EPS in the numerator, let us say these are convertible preference shares, then you will start where the basic EPS ends, where you will take the profit available for equity shareholders for basic EPS. In the numerator, you will say that this profit must be after deducting preference dividend. But if these preference shares were converted, I will add back preference dividend in the numerator. Further, if these were convertible debentures, this profit would have been after deducting interest. However, if these instruments were converted, I will add back interest. Again, I will add back interest or preference dividend as a case maybe. After considering all the direct and indirect consequences, like for example, preference dividend is usually not tax deductible unless the question tells you, but interest is usually tax deductible, and hence if I were to convert the debentures at the start of the year, undoubtedly I will save interest, but at the same time my profit before tax, that is taxable income, will increase, and so will my tax, and hence my actual savings will be interest into 1 minus T. Well, why just interest and tax? It is very much possible that there was a managerial remuneration which was based on the net profit. If the debentures were converted at the start of the year, that will increase my net profit and thereby increase my managerial bonus or remuneration along with its tax impact. So when I look at the EPS working, diluted EPS working in the numerator, I will take all the direct like interest saving or preference dividend saving, as well as indirect like the consequent tax or a DDT or a managerial remuneration impact in the numerator, as if actually the conversion had happened, then what would have been the impact. Next, in the denominator, you will calculate the weighted average number of shares. You must have taken the shares for the basic. To that, you will add the number of shares on the conversion of these potential equity instruments. Remember, when you do this working, you will get a number. It has to be lower than the earlier, let's say, basic EPS calculated. Because if it is higher, then these instruments are called as anti-dilutive and should not be taken into the EPS calculation. Because it is diluted EPS and not potential EPS. And hence, even if only if these potential instruments reduce the EPS, only then will we take, otherwise no. Okay. Now, it is possible that in certain cases, there may be multiple conversion ratios. In such a case, you will take the conversion ratio typically which results in the maximum dilution, that is the highest number of shares to be issued. So, usually, the ratio which results in the maximum dilution should be taken. Now, for potential equity shares which are in the nature of preference shares or in the nature of debentures, in the numerator, add back preference dividend if there is DDT into 1 plus DDT, but that is rare because DDT is abolished. And if there is interest into 1 minus T in the numerator. In the denominator, the number of shares issued will be added in the denominator. Okay. All of this work in a manner similar to AS20. However, the challenge over here will arise in case you have market rate of interest on similar non-convertible instruments given, in which case 109 liability and equity component bifurcation will get triggered. Remember, if nothing is given in terms of market rate on similar non-convertible instruments, you will not be able to segregate between the liability and the equity component. However, if a data is specifically given, you will have to take that, and as a result you will segregate between, let us say, just a second. Sorry, you will segregate between the liability component and the equity component, and you will have to do the working accordingly. Sorry, there was some issue. So when we look at the preference shares or debentures where there is a market rate of interest given, then you will have to segregate the liability and the equity component. Sir, why? Well, because the expense that goes into the P&L is your liability component into the EIR rate, and hence in the numerator the interest savings will be the liability component into the EIR. Again, if there is any tax rate given, you will do this into 1 minus T. In the denominator, remember, you will take the potential equity shares. You will not really bother about the equity component or anything. Whatever are the potential equity shares, they may be compulsory convertible, optionally convertible at the holder's choice, optionally convertible at the issuer's choice. You will take the shares that are expected to be issued on conversion in the denominator for the purpose of this working. But the important thing is, when will I do that? If the market rate of interest on similar non-convertible instruments is separately given. If no such rate is given, you will not be able to segregate, and hence you will do the working in the usual manner. When you calculate the impact on conversion, all possible impacts should be considered, as we discussed earlier. Further, sometimes instrument asks you to calculate incremental EPS, in which case you will just take the ultimate cost savings, let's say interest after tax, everything, in the numerator, and the number of shares to be issued on conversion in the denominator. Are we clear with this? Okay, so over here there are quite a few questions which are quite interesting and we would want to address. Let us say you go to question number 14 over here. It is an important question. The other questions regarding options, etc. we'll do in some time. Question 14 is important. What are you asked to do at the end? Calculate the basic and diluted EPS both. So over here on 30th June, The issued capital of the entity consisted of 15 lakh ordinary shares of 1 rupee each, and on 1st of October, the entity issued 12 lakh 50,000 of 8% convertible loan stock for cash at par. So this was issued on 1st October. Each 100 rupee value of stock may be converted at any time during the years between 16 to 19, and the number of shares are set out below. So you have been given the various, so there are multiple conversion ratios. If the loan stocks are not converted by 2019, they would be redeemed at par. There are two different ways of assessing the instruments under Ind AS 32. Conversion option to convert into a number of shares, which varies only with time. Remember, when you do Ind AS 109 and 32, if there is variability in the number, it is actually liability in nature. However, if the variability is due to time, or there are certain other exceptions like bonus, etc., then it can be taken as equity. So they are saying over here that there are two ways in which you can assess that the conversion option, which is varying only due to time, there is no other reason, can either be viewed as an option to convert into a variable or a fixed number of shares and recognize either as a liability if it is variable or equity. Aja, this question assumes that the return equity conversion option is accounted for as a derivative liability. The question tells you. So they're not asking you how it should be classified. They're saying that solve as if it is classified as a liability. And mark to market using profit and loss. So this is accounted using FADPL. The change in the options fair value for 2012 and 13 was 2,500 and 2,650 respectively. It is assumed that there are no tax consequences arising from these losses. Interest may be tax deductible, but these losses are not. Profit before interest, fair value movements and taxation for the year ended 30th June 2012 and 13 is 8,25,000 and 8,95,000 respectively, relating to continuing operations, and the rate of tax is 33%. Now, for calculating basic EPS, you need to find the profit for equity shareholders. So let us say if I look at the first year, let's say if I take the first year, which is 8,25,000, this is before interest, and hence should I deduct the interest? Yes. What is the interest amount? Well, 12,50,000 into 8%, but can I say this is 1 lakh for the entire 12 months? This was issued on 1st October and hence into 9 by 12, and hence this will be minus 75,000. Now in chronology, what should you next deduct? Well, students usually end up saying that we will deduct fair value losses, but if you do that and then calculate tax, then you have taken the tax impact even on fair value losses, which is not correct, and hence you will on 7,50,000 first deduct tax at the rate 33%, come with 5,02,500, and on that you will deduct 2,500 of fair value loss because there is no tax consequence over here. So this will come to 5 lakhs. On exactly similar lines, you look at for the year 2013, just that over here the interest is for the entire 12 months because the loan was outstanding for the entire 12 months. First you will subtract interest, then you will subtract tax, and then you will have fair value loss, and this will give you 5 lakhs divided by 15 lakhs. There is nothing which is converted, and hence 0.33 and 0.353. Now when you go to diluted EPS, diluted starts where the basic ends, and hence if I look at the first case, I will say in my numerator my profits are 5 lakhs. In the denominator I will start with 15 lakhs. Well, if preference shares or these loans were converted, how many will that be? Well, this is 12,50,000 divided by 100. Now, if they were converted, the maximum dilution will happen if they were converted into 135 shares, and hence this is what I think into 135 comes to I think 16,87,500. However, the earliest date where they can be converted would be 1st of October, not before that, and hence into 9 by 12. Okay, this is your denominator. In the numerator, if they were converted, 75,000 of interest will be saved, but along with that, tax impact will also arise. That is 0.33, 1 minus 0.33, and 2,500. Will I do into 1 minus t over here? The answer is no, because they do not have any tax impact. So there will be no consequential tax savings which need to be reversed. So 75,000 into 0.67 plus 2,500 plus 5 lakhs comes to I think 552, 750. And that will be divided by, so this is 552, 750. This will be divided by 1687,500 into 9 by 12 plus 15 lakhs, that is 27 lakhs, 67,625, and hence 0.2. This is lower than basic and hence diluted. The same logic will apply for the year 2013 as well, where you will add back interest of 1 lakh into 1 minus t plus 2650 of fair value losses. But in the denominator, the entire 1687,500 will be added. Okay, so that takes care of question number 14. Next, you go to question number 15. Okay, an entity issues 2,000 convertible bonds at the beginning of year 1. The bonds have a 3-year term and are issued at par with the face value of 1000 per bond, giving total proceeds of 20 lakhs, that is 2000 into 1000, that is 20 lakhs. Interest is payable annually in arrears. Arrears means at the end of the year at a nominal amount of 6%. So 6% into 20 lakhs, can I say this will be 1,20,000 per annum. Each bond is convertible at any time up to 250 ordinary shares, and hence if there are 2000 bonds, 2000 into 250 will come to maybe 5 lakh potential equity shares. The entity has an option to sell the principal amount of the convertible bonds in either ordinary shares or in cash. Remember, the option over here rests with the entity. So this is an optionally convertible bond at the entity's choice. If the entity decides that it has to settle in shares, then this can be in the nature of equity. If it decides it is going to pay in cash, then it can be taken in liability. Sir, but what if nothing is given? Then as per the updated treatment of ICAI, you will treat the principal amount in the nature of equity. If it was specifically given that it is going to be repaid in cash, that is when you will take it in the nature of liability. So over here, when the bonds are issued, prevailing market rate of interest on similar bonds without a conversion option is 9%. Now, if this data is given, you have to segregate between the liability and equity component. At the issue date, the market price of one ordinary share is ₹3. Income tax is ignored. Calculate the basic and the diluted EPS when your profit attributable to ordinary shareholders, this must be after finance cost and everything, is 1 million or 10 lakhs. Ordinary shares outstanding is 12 lakhs, and hence 10 divided by 12 comes to, I think, 0.833. This is, let us say, your basic EPS, and the convertible bonds outstanding are 2000. Now, if I want to find the diluted EPS, I will have to figure out the liability component and the equity component. Well, the issue proceeds are 20 lakhs, and hence if I want to find the liability component, I will say initially I have a contractual obligation to deliver 1,20,000 at the period over 3 years. So this is PVF at the rate of 9% for a period of 3 years. Now the question arises that what should I do? Should I also take the principal? Well, earlier the treatment by the institute was slightly different. Now they've updated it and said that, well, if nothing is given, we will assume that the settlement can be happening in the form of shares, and hence there is no obligation which is now unavoidable on the entity, and hence they have taken it as 0, though alternative solution is very much possible. And hence this will come to around, if I go to see, 3,03,755 is your liability component. For academic completion, you can even find the equity component. But remember, this is just a second for academic completion, because equity component is not going to be used anywhere, and hence this will be 20 lakhs minus 303,755, and hence this will be around 16,96,245. Okay, now why did we do all of this? Because in the numerator, when this 10 lakhs would be calculated, this will be after finance cost, and finance cost will be the liability component, that is 3,03,755 into, can I say, 9%, and hence 27,338 will be your interest. There is no tax, and hence for diluted EPS you will take 10 lakhs in the numerator plus 27,338. This you can only find if you were to segregate between liability and equity, which you can do in this question because the market rate on similar non-convertible instruments is given. In the earlier question it was not given. And in the denominator you will have 12 lakhs. To that you will add 250 into 2,000, which is 5 lakhs. Again, this will be outstanding for the entire 12 months, and hence if we do this working, you will get probably 17 lakhs in the denominator, and hence 0.604 or something. Is this lower than basic? Yes, and hence this will be taken as diluted. Now over here you can take this concept as a base and go probably to the most important question, I would say, in this chapter. So if you have time to revise only one question in this chapter, I would say question number 16 is that question. Let us review this. CAB Limited is in the process of preparing the CFS for the group as on 31st March 13, and the extract of the same is given below. So you have been given the profit for the year, 39,000, other comprehensive income, total comprehensive income, NCI and everything. For me, for EPS calculation, the relevant number is the profit attributable to CAB. OCI will not be taken, NCI will not be taken, and as a result, all of these numbers are irrelevant. You will only look at 39,000, but remember 39,000 is the profit for the year, which must be after finance cost, but it must be before appropriations, which would have been deducted in retained earnings. Everything is given in thousands. The long-term finance of the company comprises of the following: 0.1 and 2 are in thousands, 2 lakh equity shares at the beginning of the year, and the company has issued 50,000 shares on 1st July at full market value. So if you look at the time weight, 2 lakh into 12 by 12 plus another 50,000 into, let us say, 9 by 12, and hence this is 2,37,500 as of now. Next, you will have 80,000 irredeemable preference shares. These shares are in issue for the whole of the year ended 31st March 13, and the dividend on these shares is discretionary. Can I say that means these preference shares are in the nature of equity? They may be equity, but are they equity shares? No. So will they be added in the denominator? No, they are not equity shares. They may be equity. Okay. Before you read the third point, last में देखो क्या दिया हुआ है. In the year ended 31st March 13, CAB declared an ordinary dividend of rupees 0.1 and dividend of 0.05 per share on the irredeemable preference shares. Compute the following. So this is a dividend of 0.05 into, can I say, 80,000 irredeemable preference shares. So over here you will have, let us say, 0.05 into 80,000. Now the question over here is this 4,000 already deducted while calculating 39,000? Think and tell me. The answer is no. Why? Because this is net profit, and net profit is after finance cost. However, finance cost includes amounts that you are paying in the nature of, let's say, liabilities. This is in the nature of equity, and hence would have been separately deducted while calculating retained earnings. So over here, this is 39,000, which must be before deducting this 4,000 of dividend, and hence I'll have to deduct it separately. Further, point 3 says 18 crores of 6% convertible debentures issued on 1st April 11, 2 years back, and repayable on 31st March 15. So that is a term of 4 years at par. This is repayable. Interest is payable annually, and as an alternative to repayment at par, holder on maturity can elect to exchange their convertible debentures for 10 crore ordinary shares, which means, can I say there is an option to convert? Yes, and hence this is an optionally convertible debenture where the option rests with the holder. On 1st April 11, the prevailing market rate for a 4-year convertible debenture, which has no right of conversion, was 8%. Okay, so market rate of interest is given, and hence I'll have to segregate the liability and equity component. Using a discount rate of 8%, the present value of 1 rupee in 4 years is 0.74, and the annuity factor is 3.31. Okay, so over here, I will have to segregate between the liability and the equity component, which is easy, I would say. If I were to do everything in thousands, I think 1,80,000 in thousands will be around 18 crores. Then I look at the liability component. This is 1,80,000 into whatever is the coupon rate, which is I think 6%. That is 10,800. Initially, there is an obligation to deliver cash for a period of 4 years, which is 3.31. Will I include the principal value? Yes. Why? Because this is optionally convertible at the holder's choice. If the holder demands, the issuer has to pay. And hence, you will take another 1,80,000 into, can I say, 0.74, and hence if you do the math, this is 10,800 into 3.31 and 1,80,000 into 0.74, and hence the total comes to what? 1,68,948, and hence the equity component would be the difference between this and this is 11,052. Therefore, if I look at the interest that is to be charged, interest is on the liability component, but when I take 168,948, on that interest will be the interest for the first year into 8%. This is 13,516 less payment, which is I think 10,800. This will give you the closing liability component, and hence this is around 171,664. You will take that as opening into, let's say, 8%, comes to 13,733, 10,800 less, and hence the closing comes to around 174,596 or 597. So over here, in the second year, this is the interest for the year 12-13. Upar ka jo interest hai, that is for the year 11-12. That is the first year. In the second year, while calculating your profit, 13,733 would have been already deducted as a part of finance cost. Do I need to deduct it again for calculating basic EPS? The answer is no. It would have already been deducted, and hence you don't need to deduct it again. Okay, so over here, when you calculate the basic EPS, you will start at 39,000. From this, you will subtract 4,000 because this is on preference shares which are classified as equity. Remember, convertible debentures, liability component on that, whatever is the interest, would have already been deducted in finance cost and hence need not be deducted again. In the denominator, you will take 237,500. Remember, no part of irredeemable preference shares are taken in the denominator. So when we do this, this is what 35,000 divided by 237,500 comes to, I think, 0.147. Now when you look at this, this is 0.147. When you look at diluted, you will start with the basic ends, that is 35,000, and in the denominator you will start again where basic ends, 237,500. On conversion, there are 10 crore shares and they are potential for the entire 12 months. So you will add the entire 1 lakh or 10 crore shares. Remember, for 80,000 preference shares, they are not potential equity shares and hence they will not be added in the denominator. Further, in the numerator, we are trying to say that, well, 35 is after deducting 4. You don't need to add back 4 because this is still a payment made to not a potential equity share. However, there is interest that must have been deducted of 13,733. This must have been deducted while calculating the profits. Okay, and hence this has to be added back. If there's a tax rate, you'll have to make adjustment on that. What you have to do, finance cost of convertible debentures and its closing balance, we have done. Basic and diluted EPS for the year ended 31st March 13 and the tax rate is 25%. So over here into 1 minus 0.25. So this is 13,733 into 0.75 plus 35,000 comes to, I think, 45,300 upon 337,500 which comes to what? Can I say 0.134? And hence this is diluted. So this is arguably the best question in this chapter because it has convertible instruments, preference shares which are classified as equity, OCI, NCI, multiple years, tax rate. So if you have time to revise one, this is that question. Okay, so these are a few examples pertaining to potential equity shares. There's also one interesting question, I think question number 11, which is also an interesting question on these convertible instruments, which we will try to address. On 1st January, shares in issue are 10 lakhs. Okay, 5% convertible bonds are 1 lakh. And terms of conversion are 120 ordinary shares for rupees 100, which means 1 lakh divided by 100 into 120, I can say 1,20,000 potential equity shares on 31st March. Holders of 25,000 bonds converted into ordinary shares. This is 25,000 divided by 100 into 120. Probably this would be 30,000 equity shares converted on 31st March. Profit for the year ended 31st December is 2 lakhs. This is profit. Can I say it must be after deducting whatever is the applicable interest? Yes, they've clarified to be after interest. Tax rate is 30%. Again, if nothing is win, the profit refers to the net profit, which will be after tax. Calculate the basic and the diluted EPS. Ignore the need to split the convertible bonds into liability and equity components. Even if that sentence was not given, you don't have the market rate of interest on similar non-convertible instruments, and hence even if you want to, you cannot segregate. So over here, if you first want to calculate the basic EPS, the profit which is there, I think which is given at the end is 2 lakhs. This is after interest and hence after tax, no adjustment needed. In the denominator, you'll have to take actual equity shares, which is 10 lakhs for the entire 12 months. However, during the year, there was a conversion. And on that conversion, 30,000 shares were issued on 31st March. Let us say the year ending is 31st December and hence this will be for 9 months. So this will be 2 lakhs divided by, I can say 10 lakh 22,500. So 2 lakhs divided by 10,22,500 comes to around 0.196. This would be your basic EPS. Now when I go to diluted, in the numerator, I will have to add back interest on instruments that are potential. Now can I say out of the total 1 lakh, 25,000 worth of bonds and then there are 75,000 worth of bonds. These 75,000 bonds will be converted into 75,000 divided by 100 into 120. Can I say this is 90,000 potential equity shares? But have they actually converted? The answer is no. And as a result, in the denominator, I will add back 90,000 into 12 by 12. Further, on this 25,000, there would be, as we have calculated earlier, 30,000 potential equity shares. Have they converted? Yes. But when have they converted? Sir, they have converted on 31st March. Remember, EPS is for the year and not as on date, and hence, were they potential for the first 3 months? Yes. And hence, when you look at this working, you will say in the numerator, you have 2 lakhs. In the denominator, you will start where basic ends. Basic ends at, I think, 10 lakh 22,500. Okay. Other than that, I will say plus 90,000 into, can I say 12 by 12? Plus 30,000. Sir, 30,000 has already been included in 22,500 for the last 9 months when they became actual. However, for the first 3 months, they were actually potential, and hence into 3 by 12. Sir, they later got converted, it does not really matter. And hence, if they were potential for a part of the year, you will have to take it. So if I do all of this, I will probably get around 11 lakh 20, and 2 lakhs divided by 11 lakh 20 comes to around 0.17, no, hold on, 179. But in this is a denominator adjustment. Will there be an adjustment in the numerator? Well, I'll have to add back interest. Acha, interest on 75,000 into, what is the rate? I think this rate would be 5% on 75,000. 5%. Can I say this would have been the interest for the entire 12 months? But yahan pe you will also have into 1 minus t. Okay, so over here, I can say that this 75,000 was outstanding for the entire 12 months. Had they be converted in the start of the year, I would have saved this into 1 minus 0.3 into 12 by 12. Further, for this 25,000, where say in the last 9 months, there would be no interest because they got converted. However, in the first 3 months, would there be any interest? Yes. So this would be 25,000 into 5% into 1 minus 0.3 into, let us say, 3 by 12. Because for the first 3 months, they were potential. We are assuming that what if instead of 31st March, they were converted on 1st of January, then for the first 3 months also interest nahi aayega. And hence to this, you will add 75,000 into 5%, that is 3750 into 0.72625 and 25,000 into 5% into 0.7 into 3 by 12, 218.75. And hence, if I total up, this is what? I believe 2,02,843 divided by 11 lakh 20. So 2,02,843.75 divided by 11 lakh 20, and that will give you the diluted EPS. Okay, next, before you go to question number 12, we will go to the next section over here, which involves options and warrants. Now, remember, in case of shares, whether it is preference shares or whether it is, let us say, debentures, what will happen is you will have the, on conversion, you will have the entry debentures account debit to share capital or liability component account debit equity component account debit to share capital. Will there be any flow of money? No. However, if there are options or warrants, do they have the potential to become equity shares? Yes. For example, there are 1,000 options, or we can take an example over here only. It's not an important question, but let us say if I were to take this as an example. Now, there were 10 lakh shares in issue. Profit for the year was 1 lakh, which means 0.1 would have been the basic EPS. The company has in issue 2 lakh options to purchase ordinary shares, and the exercise price is rupees 6. The fair value during the year is rupees 8. Calculate the diluted EPS. Now, if I go to see over here, when I calculate the basic EPS, this is 1 lakh divided by 10 lakhs, that is 0.1. However, when I calculate the diluted EPS, do I pay any interest, dividend or anything to the options? The answer is no. And hence, when I go from basic to diluted, I will say in the numerator, 1 lakh will remain the same. In the denominator, 10 lakhs plus, can I say the company has an option, has issued an option on 2 lakh shares? Yes. And hence, there is a potential to issue 2 lakh equity shares, which means I will add 2 lakhs. Nothing will be added in the numerator, and that will ideally give me the diluted EPS. However, one needs to remember that is wrong. This is a natural trap. Well, why is it wrong? Fundamentally because when the options are exercised, your entry will be bank account debit. In your company, will I actually receive 2 lakhs into rupees 6? Have the options been exercised? No. But if they were exercised, then at the start of the year, there would be a resources of 12 lakhs which will flow into the company. Okay, against this 12 lakhs which is flowing against the company, I could have deployed it and earned more profit. How much more profit is very ambiguous, and hence the standard suggests a method where it assumes that what will I do with that money? Well, I will use it to buy back the entity's own equity shares, but when I go to buy back, I'll have to buy back at the fair value. So what will happen is, when I issue 2 lakh shares, that will be 2 lakh shares issued, I'll receive maybe 12 lakh rupees, and if I go to buy it back at the rate of 8, I can buy back 1,50,000 shares. So basically the incremental shares that will be issued will be 50,000, and hence in the denominator what I can take is only the incremental shares. The logic over here is, in a conversion of preferences or debentures, the entry is debentures account debit to share capital. That's it. However, in case of options, the entry is bank account debit to share capital, and hence money is coming inside the company that can actually increase the profit. However, I don't know what will be the increase in profit, and hence I have to take that money out of the company. How will I take it out of the company? I will debit the share capital and the reserves, as a case maybe, and credit bank. And when I do that, I will try to find the number of shares to be bought back, let us say 1,50,000 against 2 lakh shares to be issued, and hence 50,000 incremental shares will be remaining after 12 lakhs has come in and 12 lakhs has gone out, and hence that will dilute your EPS. So over here this will be 1 lakh divided by probably 10 lakh 50, and hence it comes to 0.95, and that is your diluted. So over here there is a concept of incremental shares. Incremental shares is the shares issued on exercise. In our example this was 2 lakhs, and the number of options, which is 2 lakhs, into the exercise price of 6 divided by the average market price. I will use the 12 lakhs that I have received to buy back equity shares at 8 rupees, and hence 1,50,000 incremental shares will be there, which will be taken in the denominator. Are we clear with this? On similar lines, we can try a question number 12 over here. So when we look at question number 12, at 31st December 17 and 18, the issued share capital of the entity consisted of 40 lakh ordinary shares of rupees 25 each. The entity has granted options that give the holder the right to subscribe for ordinary shares between 2016 and 19 at the rate of rupees 70 per share. So there is an option, exercise price is 70. The options outstanding at 31st December 17 and 18 are 6 lakh 30. There were no grants, exercise or lapse of these options, and PAT attributable to shareholders for both of these years was 5 lakhs and 6 lakhs respectively. The average market price can also change. So what do I have to do? Well, if I go to the year 2017, I will first find the basic EPS. Basic EPS is calculated as 5 lakhs divided by, in the denominator, I will take 40 lakhs. And hence 5 divided by 40 comes to, I think, what? 0.125. Now before I do diluted EPS, I'll have to find incremental shares. How will I do that? Well, if they were converted, 6.3 lakh shares will be issued. But against that, I'll get 6.3 lakhs into 70. That is the money that I will get. And I will use that to buy back equity shares at 120. So 6.3 into 70 divided by 120. So this will be 6.3 minus 3.675. And hence all said and done, you will be left with around 2.625 shares. And hence, when you calculate your diluted EPS, you will say that in my numerator, I will still have the same 5 lakhs. In the denominator, I will have 40 lakhs plus 2.625. And hence, if you look at 42 lakh, 62,500 and 0.117 will be your diluted EPS. The same working you will do for the next year 2018, just that over here, your incremental shares will change because the average market value is different. When I find the incremental shares, I'll take 6 lakh 30 into 70 upon 160. And hence, I will land up with 354 incremental shares, 3,54,375, and that will help me calculating the diluted EPS. So this is regarding options. Now, we can go on to the next section, which is presentation of EPS. Now, nothing much over here. When you look at the presentation of EPS, EPS needs to be presented on the face. Both basic and diluted needs to be presented on separate as well as consolidated financial statement separately. However, if there's a continuing operation and a discontinuing operation, like you have studied in Ind AS 105, I have to show the profits from continuing and discontinued operations separately. In a similar way, I need to show the EPS for continuing and discontinued operations as well as total operations separately. And hence, when I calculate the EPS, if there is a discontinued operation, then I will find the EPS from continuing, then EPS from discontinuing, and then EPS from total operations separately. The challenge over here is, sometimes what might happen is there may be a loss. loss, if there is a 10 lakh rupee loss and there are 1 lakh shares, the answer is a negative 10. EPS can very well be negative. However, if the EPS is negative and there are potential equity shares, let's say of another 1 lakh, then 10 lakh of loss divided by, let's say, 2 lakhs will come to loss of 5 per share. However, the loss is reducing and hence this is anti-dilutive. So usually if the potential equity shares are anti-dilutive, we will not take it into the diluted EPS calculation. However, if they're dilutive, you will take it, which is fine. The problem arises if there are 3 EPS numbers and EPS on inclusion of this potential equity share reduces the EPS from continuing operations, but it reduces the loss per share of discontinued or total operations. So it might be that for continuing something is dilutive, for discontinuing it is anti-dilutive. So can I say that I will take these potential shares at some places, not take it in some places? No. I'll have to either take it for all of them or not take it for any of them. How will I decide? Well, there is a concept of control number. Control number refers to the most important number, which is the EPS from continuing operations. If the inclusion of potential equity shares dilutes, that is reduces the EPS from continuing operations, we say that this is a dilutive security which is to be included everywhere, irrespective of whether we say that this is increasing or decreasing. It has to decrease the EPS from continuing operations. It has to be dilutive for that. If yes, then you will include it for everything. If no, you will exclude it from everything. So an example on this would be question number 18, which we can probably try to quickly review. So if you look at question number 18 over here, the following facts are given for XY. Income from continuing operations is 30 lakhs. Loss from discontinued operation is 36 lakhs. And the net loss is given to you as 6 lakhs. Okay. The weighted average number of equity shares are given to you, and incremental common shares outstanding relating to stock options are given to you. So if I look at the basic EPS, I will take 30 lakhs divided by 10 and hence that is equal to 3. This is 3.6 from discontinued operations and a negative 0.6 from total operations. If I were to include 2, should I include 2? Well, I will look at EPS from continuing operations. On my control number, if I were to include 2, this will become 30 divided by 10 plus 2, that is equal to 12. And 30 divided by 12 will come to 2.5, and hence the inclusion dilutes the EPS from continuing operations, and hence I will include the 2 everywhere. Even for discontinued operation, this will be 36 divided by 12. This is negative 3. So basically loss is reducing. So be it. I will take it because this dilutes the EPS from continuing operations. 6 lakhs divided by 12 comes to a negative 0.5. I will still take it. Next, assume if the above case, the loss from continuing operations is 10 and the income from discontinued operations is 36. In such a case, what will happen is this is 10, this is 36, and hence this will be positive 26. When I do the basic EPS calculation, this will be negative 1, this will be 3.6, and this will be 2.6. Now, if I include in the EPS from continuing operations, I will say negative 10 divided by 12, and hence this comes to negative 0.833, which means this is reducing the loss per share, and hence this becomes anti-dilutive. Higher the loss, more is the worst possible picture here. This is reducing, and hence I will say that this will still continue to be the diluted EPS. I will not include the 2 lakhs either in continuing or in discontinued or in total. Are we clear with this? So over here this is 3, 3.6 and 0.6. Over here this is 2.5, negative 3 and 0.5. This is for the first case. In the second case, this is 1, 3.6 and 2.6, and we are mentioning that inclusion of 2 lakhs reduces the loss per share and hence is anti-dilutive, will not be included, and hence the basic and the diluted will be the same. So over here we will go to the next part, which is involving a special case involving multiple potential equity shares. So if there are multiple potential equity shares, we will say, how does it matter? We will take them directly into jitne bhi share in the numerator. For every item, you will say whatever is the cost saving, in the denominator, whatever the increase in number of shares, and that's it. Boom, you will get the diluted EPS. Now, that is not a foolproof strategy. Like if you see over here, for example, if the PAT is 1 lakh, WANES are 10,000, so your basic EPS comes to 10. There's a 12% preference share of 10,000 convertible into 0.1 equity share. So this is probably converted into 100 shares. So your 10,000 into 12, this is, I think, 1200 divided by, this will convert to 100 shares, and hence for every new equity share issued, 1200 is a incremental EPS. And for debentures, this is 10,000. One debenture converts into 1 share, and hence this is again, I think, 200 divided by 1000, and hence let's say there is 0.2. So one can always say कि काम करते, we can directly do 1 lakh plus the interest saved on debentures and the preference dividend saved, which will be 1200 plus 200 upon, in the denominator you will have 10,000 plus 100 plus 1000, which means 1,01,400 divided by 11,100 comes to 9.13. Now this is lower than the basic, but is it the worst possible EPS? Well, possibly no. How can we know that? Well, let us just take debentures and not take preference shares. So if we don't take preference shares and just take debentures, this is 1,200,000 divided by 11,000. Can I say I'll get 9.109, which is lower than 9.13, and hence there was an EPS which is even lower than this number. But how will I detect this? Well, over here what you will have to do is, there are 3 or 4 steps that you will have to remember. If there are multiple potential equity shares, then you will first calculate the incremental EPS, that is cost saving by the number of shares or incremental shares. Then you will rank the securities in the ascending order, that is in the order of their dilutive impact. So the lower the cost saving per share, more is the dilutive impact. So rank the securities in the ascending order of the incremental EPS, that is the most dilutive securities are going to be ranked first. And third, you will solve it on a step by step cumulative basis, which means you will first just take the basic EPS, then to that you will just add the debentures, because debentures over here, if you go to see, with a 12 rupees incremental and a 0.2 incremental, debentures are going to be ranked first. So I will first add just the debentures, find my EPS, that is 9.11, then on that separately add preference shares. Now if this increases, this is anti-dilutive, and you will stop at around 9.11, that is your diluted EPS. So basically the things that you will have to remember is, first, calculate the incremental EPS, that is cost saving divided by number of shares or incremental shares in case of options. Second, rank them in the ascending order, that is the most dilutive securities go first and the least dilutive one goes last. Third, you will solve it on a step by step cumulative basis to find the EPS, and once you do these steps, whichever is the lowest value will be your final diluted EPS. If the EPS increases on adding a particular number, then you will ignore that, treating it as anti-dilutive. Over here we will review a question on this, which is an important question. Go to question number 19, not 19, I think question number 17. Over here, the following information is available regarding to Space India Limited for the year ended 1920. Net profit for equity shareholders is 90,000 divided by number of equity shares outstanding. This is 60,000. This is 90 divided by 16, and hence this comes to what? 5.625. The average fair value of one equity share during the year is 90. This is the average fair value of one equity share during the year. For example, this is 90. Okay. Potential equity shares, there is options, convertible preference shares, applicable corporate dividend tax, convertible debentures, and then the tax rate. What are you supposed to do? Find the basic as well as the diluted EPS for the year 1920. Basic you have found is 5.625, but when I look at diluted, I will have to calculate the incremental EPS. Now for options, there is nothing in the numerator, but in the denominator you will have to take incremental shares. How do you calculate that? Well, 900 options minus 900 into 75. This will be your proceeds that you will receive divided by the average price of 90. 900 into 75 divided by 90 comes to 750, and hence this is 150 incremental shares, and hence this is 0. Second, 7,500 shares entitled to a cumulative dividend of 9 per share, and hence this is 7,500 into 9. Each preference share is convertible into 2 equity shares. Again, there is a corporate dividend tax. Remember, if I don't have to pay preference dividend, I will not even pay the dividend distribution tax, and hence yes, I will save 7,500 into 9, but I will also save a plus 8% DDT on that. But against that, I will have to issue 7,500 into 2. Can I say that is equal to 15,000 equity shares? And hence this is 7,500 into 9 into 1.08, 72,900. So this comes to 72,900 divided by 15,000, and hence this will come to probably 4.86. This is your incremental EPS. Third, for convertible debentures, 10 lakhs, and each debenture is convertible into 4 shares. 10 lakhs into 10% will come to, let us say, 1 lakh. Acha, tax rate is 0.25, so this is 1 lakh into 1 minus 0.25. So this will be 75,000. And 75,000 divided by every instrument, that is 10 lakh divided by 100, that is 10,000 instruments, gets converted into 4 shares. This is divided by 40. 75,000 divided by 40 comes to, I think, 75,000 divided by 40 comes to 1.875. Now, if I have to give the ranking, the lowest cost saving is in options, so that goes first. Second is in debentures, and third is in preference shares. So when I do the working over here, I will do on a step-by-step cumulative basis. So I will first start with the numerator of 90,000 divided by the denominator of 16,000, and hence get 5.625. Now to this I will add options first. This is nothing in the numerator and 150 in the denominator. So this is 90,000 divided by 16,150. Bhale chota amount ho, but it is a fall, and hence this is 5.57. It is lower, and hence this is dilutive. For the next, you guys tell me, I will add what? Sir, debentures. 75,000 of interest net of tax saving divided by 40,000 of shares to be issued. So this is what? 1,65,000, and this is 16,150, and 40,000 comes to 56,150. So this is 165 divided by 56,150 comes to 2.94. Again, this is lower, and hence this is dilutive. Further, I will now add preference shares. This is 72,900, and there is a 15,000 further increase. So this is probably 165 and 72,900 comes to around 2,37,900, and you will divide this by maybe, I think, around 71,150 shares, and hence this is 237,900 divided by 71,150, and this is 3.34. As you can see, this is increasing, and hence this is anti-dilutive, and you will stop at 2.94, which will be your final diluted EPS. Are we clear with this? So over here, this is regarding question number 17. Now the last two questions which are there are one on contingent shares and second on group EPS. First, we will go to contingent shares. The last of these instruments would be contingent shares. Now, what do you mean by contingent shares? So, for example, there was a business combination, and in that, as a part of the PC, we had contingently agreed to issue shares depending on how the user base, etc., develops in the future. Now, sitting today, let's say Facebook acquired WhatsApp, and they said 3 years later, depending on your user base, we will issue you shares. Maybe if your user base is less than 100, then nothing. Between 100 and 150, then maybe 2 billion worth of shares. More than 500, then maybe 5 billion worth of shares, let's say. So over here, this will be how many shares to be issued will be known after 3 years. However, I have to show the EPS in each of the 3 years, and hence, when we do the workings, we will try to calculate the basic EPS. For basic EPS, you will include the contingent shares in the calculation only if the shares are actually issuable. So till the time 3 years go by, the shares are not actually issuable, and hence you will not include them in the basic EPS calculation. However, are they potential? Yes. From which date are they potential? From the date of the contingency agreement, and hence you will include that into the diluted EPS. However, these are contingent shares. So how many shares should be included? Well, the standard says that you will include the contingent shares into your diluted EPS considering the current period to be the end of the contingency. Like in the first year end, if WhatsApp has a user base of, for example, 150, in which case if the current period were to be the end of contingency period, then how many shares are to be issued? Let's say 2 billion shares are to be issued, then 2 billion will be taken. Later, the user base falls to, let us say, 80. Then how many shares are to be issued? Let's say 0. Then you take 0. But ultimately, let's say the user base goes up to 600. Then how many shares are to be issued? Let's say 5 billion. And hence, you will keep on taking the shares from the start of the year or the date of contingency agreement, depending on if the current period were to be the end of contingency, then how many shares will be issuable, and you will take that into the diluted EPS calculation. So over here for contingent shares, basic EPS, shares should be included in WANES only from the date conditions are fulfilled. That is, the shares become issuable. Whereas in diluted EPS, to be included in the current period as potential equity shares, only if the shares are issuable considering the current period to be the end of the contingency period. Remember, potential shares have to be included from the date of the contingent share agreement or start of the year, whichever is later. And prior period restatement is not needed. Considering that, you have this question number 19, which is also an important question which we will try to tackle. So over here, ordinary shares outstanding during the period are 10 lakhs. There was no options, warrants or any other convertible instruments. An agreement relating to a recent business combination provides for issue of additional ordinary shares based on the following conditions. Okay, retail contingency, 5,000 additional shares for each new retail site to be opened. Okay, earnings contingency, 1,000 additional ordinary shares for each rupees 1,000 of consolidated profit in excess of 20 lakhs for the year ended 31st December 11. So this is profits for the entire year. Retail sites opened are one in May 11 and then one in September 11. Next, consolidated year to date. This is not quarterly, this is year to date. Profit attributable to the ordinary shareholders is 11 lakhs. Then is 23 lakhs as on 30th June. But this is year to date. That means this is for quarter 1. Let's say for quarter 2, can I say the profit would have been 11 and 23 ka difference? Can I say that must be 12 lakhs? In quarter 3, it goes down. Well, year to date profit is 19 lakhs as on 30th September. This is year to date. But in the first 6 months, I have done 23 lakhs. Now it is 19 lakhs. And hence, in quarter 3, if required, there would be a 4 lakh rupee loss. And last quarter, in quarter 4, from 19 lakhs, I jump up to 29 lakhs and hence there is a 10 lakh profit. You are required to calculate the basic and diluted EPS on quarterly as well as annual basis. First, we will take the annual EPS. We will first take the basic EPS. As per basic EPS, in the numerator, you will take the profit for the entire year, 29 lakhs, divided by, you will take your ordinary shares, this is 10 lakhs. Other than that, in the current period, one new site was opened in May and hence 5,000 shares become issuable on 1st May and hence outstanding for 8 months. The next site is opened in September and hence it is these 5,000 shares become issuable and hence this is into 4 by 12. Now as a matter of fact, on earnings contingency, the profits exceed 20 lakhs. However, that is profits for the entire year and hence they exceed at the last day of the year and hence the shares will become issuable from the first day of the next year and hence in the current period, the shares are not issuable under the earnings contingency. And hence, this will be, if I were to take the basic EPS, 29 lakhs divided by probably 10 lakh 5,000. And hence, 29 lakhs divided by 10 lakh 5,000. And this will come to around 2.89. This will be your basic EPS. Now, if I go to diluted, I will say that if the current period were to be the end of contingency, then were any shares issuable? Well, in the numerator, there is no adjustment. In the denominator, I will start where the basic ends. Let's say 10 lakh 5 alternative presentation is possible. I will then say that if the current period were to be the end of contingency, then 5,000 shares are issuable under the retail contingency. They are actually issued on 1st of May. However, they are potential from the start of the year. I'll again repeat, they are issued from 1st of May, but they are potential from the start of the year. And hence, plus 5,000 into the first 4 months. When they were actually potential, the next 5,000 are issued on 1st of September. However, they are potential for the first 8 months and hence this is into 8 by 12. Further, for earnings contingency, 29 minus 20 upon 1,000 into 1,000, that is 9 lakh shares. However, these 9 lakh shares are actually issuable from the next year. However, if the current period were to be the end of contingency, then 9 lakh shares are issuable. They are potential. And their potential from which date? Well, from the start of the year or the date of the contingency agreement and hence in the diluted EPS, this 9 lakhs into the entire 12 by 12 will be taken because they are potential and hence you will take in the denominator, you will take 19 lakh 10,000 and in the numerator 29 lakhs and hence your answer comes to what? 1.518 or 1.52. Are we clear with this? Now, this is done on an annual basis. If I have to do this on a quarterly basis, I'll discretely look at each quarter. Like in the first quarter, the income is around 11 lakhs. If I were to find basic EPS, no new shares were actually issued. 11 lakhs divided by 10 lakhs, that is 1.1. But when I look at diluted EPS, if the current period were to be the end of contingency, are any sites opened? No. And hence, are any shares issuable under retail contingency? No. Further, the profits till the current period are around 11 lakhs and based on that, no new shares would be issued if the current period were to be the end of contingency, and hence there will be the same 1.1 in diluted. Now when you go to the next quarter, this becomes interesting. First of all, you should not take 23 lakhs, you should take the quarterly, and hence 23 minus 11, that is equal to 12 lakhs. Now in the second quarter, can I say on 1st of May 5,000 shares were issued, but they were issued on 1st May. This quarter is only 3 months. Now can I say out of those 3 months, these shares were issued on 1st May and hence were outstanding for 2 months. And hence when I do the working, I will take 12 lakhs divided by 10 lakhs plus 5,000 into 2 by 3. So I will say that if you look at the current year, current quarter, based on the current quarter, actual shares have been issued in May and are outstanding for 2 months out of the 3 months in the quarter, and hence I'll do 5,000 into 2 by 3. When I look at the diluted EPS, again in the numerator I will still have 12 lakhs. In the denominator I will have where the basic ends. So this is 5,000 into 2 by 3 comes to, I think, 10 lakh 3,333. These shares are actually issued in May. However, if the current period were to be the end of contingency, these shares were potential from the very first day, and hence 5,000 into 1 by 3. You will also adjust over here. Further, if the current period were to be the end of contingency till date, you have earned how much? Say 23 lakhs. And as a result, if the current period ends and the contingency ends over here, then I'll have to issue 3 lakh more shares. And these are potential for the entire 3 months. So this is plus 3 lakhs. If the current period were to be the end of contingency, 23 minus 20, 3 lakhs divided by 1,000 into 1,000. These are not actually issued, but if the current period were to be the end of contingency, then these 3 lakhs would be potential, and hence they have been taken, and this is 0.92. In the third quarter, there is a loss. In the third quarter, there is a loss of around 4 lakhs divided by, I will start with 10 lakhs, which is there for the entire 3 months, plus 5,000 shares which were issued for the store opened in May, again for the entire 3 months, and another 5,000 which is for the store opened in September for only 1 month. So this is 10 lakhs plus 5,000 into 3 by 3 plus 5,000 into 1 by 3. For earnings contingency, nothing is to be issued, and hence 0.4. Now, if you do it directly, you can say that, well, 4 lakhs divided by, if the current period were to be the end of contingency, I will start with where basic ends, and hence I'll start at 10 lakh 6,667. May shares have been fully included. As per earnings contingency, nothing is issuable because you are at 19 lakhs now. But when you look at retail contingency, for the shares which are issued in September, they were potential for the first 2 months, and hence 5,000 into 2 by 3. You will do the adjustment, and thereby you will come to 10 lakh 10,000. And hence ideally your answer will be 0.4 negative. However, remember in this case, there is a loss, and hence you have also been given including a 4,50,000 loss from a discontinued operation. Now, if my total loss is 4 lakhs and 4,50,000 is coming from a discontinued operation, that means, can I say, the remaining 50,000 profit must have come from the continued operation. So the profit from continuing operation is 50,000. If I take, let us say, over here in quarter 1, in quarter 3, EPS from continuing operations falls on the inclusion of 3,333 potential shares, and hence we will include them even in the discontinuing as well as total EPS. Here we have done the working based on total. However, we have included the 3,333. These we have included because the inclusion of these items will dilute the EPS from continuing operations. That is 50,000 divided by 10 lakh 6,667 and 50,000 divided by 10 lakh 10,000. You will find that the inclusion of this 3,333 dilutes the EPS from continuing operations, and hence we will include it everywhere. And for the last quarter, you will say that the profit of the last quarter is maybe 10 lakhs divided by, in the denominator, you will take 10 lakhs for basic plus, I will say, another 5,000 for the entire 3 months, 5,000 for 3 months. Nothing is issuable under the earnings contingency. And then for diluted EPS, if the current quarter were to be the end of contingency, then 9 lakh shares become issuable, and hence you will take this into the working. It's a fairly complicated thing, especially if you consider the quarterly workings as well. However, this question has not yet come in the past in the exam, and hence it has all the likelihood of coming in the recent future, and hence do that properly. Okay, question that we just did about contingency, as all other questions जो भी हमने पढ़े, majority of them in some or the other form have come in the exams. This question has not come, and hence there is a high possibility of this coming. The last part over here is on group EPS. So in group EPS, institute asks a specific type of a question where it will give you data regarding a parent, it will give you data regarding a subsidiary, and based on that, you're asked to calculate the EPS. Now this is a little complicated. Thankfully has never come in the past in the exam. But again, that is what makes it more probable of coming. So we'll probably try to do this with a sum so that it is better understood. This is the last question, question number 20 for this important sections. And we've covered, I think, important bol ke we've covered a lot of questions, almost the entire chapter. So calculate the subsidiaries and the groups basic and diluted EPS. They're not asking for parent, so we are not doing it. When the parent, there is profit attributable to ordinary shareholders of the parent entity is 12,000, and this is excluding any earnings, any type of earnings or dividends from the subsidiary. So this is pure parent earnings. Ordinary shares outstanding are 10,000. Okay. Further, instruments of the subsidiary which are owned by the parent will be 800 ordinary shares of the subsidiary, 30 warrants exercisable to purchase ordinary shares of the subsidiary, and 300 convertible preference shares. These are held by the parent. Now, subsidiary has profit before preference dividend of 5,400. Ordinary shares are 1,000. Warrants are 150, which are exercisable to purchase ordinary shares of the subsidiary. And the exercise price is rupees 10. Average market price is 20. Convertible preference shares are 400, and each is convertible into 1 share. Dividends on preference shares are rupees 1 per share. Okay, and no intercompany eliminations or adjustments were necessary except for dividends. Assume all potential equity shares are dilutive. So if they are all dilutive, we don't need to do that ranking etc. for multiple potential equity shares. Ignore income taxes. Also ignore the classification of components of convertible instruments as liability and equity, or classification of related interest and dividends as expenses and equity as per Ind AS 32. Here, in any case, you don't have the market rate of interest on similar non-convertible instruments, and hence you cannot segregate between the liability and equity component. Secondly, the profits over here, if they say ignore Ind AS 32, will be the pure net profits. Preference shares will be like what you treat in CA Inter, like owners, and hence preference dividend will be taken in retained earnings. You have been given over here that profit is before preference dividend. Now you need to calculate the subsidiaries basic EPS. So if I look at the subsidiary is a 5,400 profit. However, this is before preference dividend, and hence I need to subtract the preference dividend, that has 400 preference shares and 1 rupee per share, and hence this is 400 divided by how many ordinary shares are there in the subsidiary, that is 1,000, and hence can I say 5 rupees per share, which means for every one actual share held, can I say 5 rupees will be the earnings that the parent will get from the subsidiary's actual share. Okay. Further, if I look at the subsidiaries, this is basic EPS. If I look at the subsidiaries, diluted EPS. Now for diluted EPS, in the numerator I will start where basic ends, that is 5,000 divided by 1,000. To this, in the numerator you will add, well, if convertible preference shares are converted, can I say preference dividend will be saved? Yes. So 400 of preference dividend to be saved will be added in the numerator. Further, how many preference shares will be there on conversion? 400, that will be added in the denominator. Now when warrants are converted, well, nothing will be added in the numerator. However, in the denominator, incremental shares, how do you calculate it? 150 minus 150 into 10 upon 20. So can I say this will be 75? And hence 75 will be added in the denominator, which means this is 5,400 divided by 1475. 5,400 divided by 1475 comes to 3.66. So this will come to around 3.66. Now remember, what does the word 3.66 mean? It means that for every one, actual or potential share, 3.66 is the earnings. So over here, there is 800 actual ordinary shares which will earn 5 rupees. There are 300 preference shares. On an actual basis, every preference share will earn a 1 rupee dividend, and on an actual basis, your warrants will earn nothing. However, on a fully diluted basis, if they were converted, then every share, now convertible preference share gets converted, and hence it stands on par with equity share. When I look at 3.66 is the earnings for 1475 instruments. Within 1475, you have 1000 equity shares. So these 1000 equity shares, then the 400 preference shares and everything will earn 3.66. So over here, on a fully diluted basis, every equity share will earn 3.66. Preference share will also earn 3.66. But when you look at warrants, incremental warrants will earn 3.66. Is 30 incremental warrants? No. So I will say 30 minus 30 into 10 upon 20. So can I say 30 minus, probably this is what, 300 divided by 20 comes to 15. So can I say 15 will be the incremental options which will also earn 3.66. So the question will ask you that calculate the group basic EPS. So when I try to do the group basic EPS, I will say that for the group basic EPS, whatever the parent is earning, obviously you will take 12,000 plus. Actually, parent has 800 shares in the subsidiary. Actual, each share will earn 5. 300 preference shares. Each share will earn 1. And 30 warrants, each of them will earn 0. Remember, in the denominator, nothing is to be added because there are no potential equity shares issued by the parent. In consolidated financial statements, in the denominator, you will only have the parent's number of shares, which is, I believe, the same, 10,000. Parent had how many? 10,000. So this is consolidated. And hence, this is 12,000 plus 4,000 plus 300. And hence, 16,300 divided by 10,000 will come to, I think, 1.63. Aja. Then you look at diluted EPS. Diluted EPS will start where we look at in the denominator still 10,000. In the numerator, you will say 12,000 plus I have 800 instruments in the subsidiary, which on a fully diluted basis will earn only 3.66. Further, I have 300 preference shares. Well, as a preference share, they will earn 1 rupee. But if they were converted on a diluted basis, they will become equity share, which will earn 3.66. And I have 30 warrants, which are equivalent to 15 incremental shares. And hence, on these 15 incremental shares into 3.66. And hence, you will take, let us say, over here, 16,080.9 upon 10,000. And hence, this will be around 1.608 approximately. Are we clear with this? This will be around 1.608 or 1.61. So this we have tried to summarize over here in terms of group EPS when parent and subsidiary data are separately given. You calculate the basic and diluted for the subsidiary in the usual manner. Then for group, you will take the parent's profits. To that, you will add parent share in S, which was 800, into the actual earnings, that is 5. Parent's preference shares, which was 300, into the actual earnings of preference share, which was 1, and then 0 for, let us say, your 0 for warrants. Then when I look at diluted EPS, we will say that, okay, on a fully diluted basis, preference shares will no longer earn 1 rupee. These preference shares will earn 3.66 rupees. But then, as the number of shares increases, even the equity shares, which were 800, will now earn only 3.66. And for incremental shares, remember why incremental shares? In the denominator, you have taken 1475. 1475 includes only 75 of the warrants, not the entire 150 warrants, and hence you will take this 75. May say you are holding 15 into 3.66, and that will give you the answer. In the denominator, parents WANES plus parents potential equity shares if applicable. Subsidiaries actual or potential shares should not come in the denominator because in the consolidated balance sheet you will only have the number of shares of the parent. So this takes care of your entire chapter on EPS. I hope you have had a very good understanding and a good overview of everything of Ind AS 33. That should be it for today's session. If you did genuinely like the content, then please press the like button so that more students can also get access to this content. And if you need anything else or any other relevant content, please put it in the comments. And any other feedback or any other thing, if you loved the video, it means a lot to us if you kind of comment as well. Gives us more motivation to do more for you guys. Okay, so please do like, share and subscribe and keep on studying hard, and I'll see you soon with another video. Till then, goodbye, good luck and take care.